If you're reading this on Thursday night, February 9th, 2026, understand this. You are not looking at normal market conditions. You are staring directly at a financial time bomb that has been quietly armed over the past 6 weeks, and the detonation sequence begins in approximately 9 hours when Asian trading desks flicker to life and the first buy orders start flowing through Tokyo and Shanghai. And what makes this particularly terrifying is not just the scale of what's about to unfold, but the fact that the vast majority of people, even professional traders, have absolutely no idea that 200,000 call option contracts, each controlling 5,000 ounces of silver, are sitting at the exact $80 strike price, expiring in 14 hours, representing 1 billion ounces of notional silver exposure, which exceeds the entire annual global mine production of 830 million ounces. And right now, at this very moment, with silver trading at $78.50 in the overnight session, we are exactly $150 away from triggering the largest forced buying cascade in precious metals history, a gamma squeeze so mechanically certain, so structurally inevitable, that the only question left is not whether it happens, but how violently the price dislocates when market makers who sold those calls realize they need to buy 350 million ounces of silver futures in a compressed time window to hedge their exposure, buying that represents 38% of the entire COMEX open interest, executed not over days or weeks, but potentially over minutes or hours, as delta accelerates from 0.6 to 0.95 the instant price crosses $80. And what makes this even more sinister is that this isn't just about derivatives mathematics or Greek letters on a risk management screen. This is about the physical market, which is already showing stress fractures that suggest the big players know something is coming, because as of 6:00 p.m. Central Time tonight, a major bullion dealer in Texas stopped taking orders entirely, not because they ran out of inventory, not because they raised premiums, but because corporate management told them to pause until the option's expiration settles. And when a dealer voluntarily turns away revenue-generating customer orders, that tells you they believe the price they're quoting today will be obsolete tomorrow, that they don't want to be locked into delivering silver at $80 when the spot price might be $95 by noon. Friday, and this isn't speculation, this is field intelligence from inside the physical market, which is already beginning to lock up 12 hours before the gamma wall even gets tested, and the historical parallel that should terrify you is March 2020, when the COMEX paper price said $12 per ounce while retail silver was selling for $25, if you could find it at all, a 108% premium that represented a complete breakdown in the arbitrage mechanism that's supposed to keep paper and physical prices aligned, except this time we don't have a Federal Reserve ready to flood the system with unlimited liquidity. We don't have refineries that can ramp up production because global mining output is structurally fixed, and we don't have mints that can catch up on orders because they're already running 6 weeks behind, which means if this gamma squeeze triggers and drives paper silver from $78 to $95 in a single trading session, the premium on physical silver could explode from the current $3 over spot to $15 to $20 to $30 over spot as dealers ration inventory. And the two-tier market emerges where paper trades at one price and physical metal trades at a completely different price. And you need to understand that the villain in this story is not some shadowy cabal. It's the algorithm, the machine learning model deployed by market makers like Citadel Securities and Virtu Financial that sold 200,000 call options because the risk model said silver's historical volatility was only 18% annualized, and therefore selling premium was safe, profitable, and statistically sound. Except the algorithm was never trained on gamma squeeze scenarios. It was never programmed to handle the possibility that 200,000 contracts at a single strike could create a feedback loop where forced hedging drives price higher, which increases delta, which requires more hedging, which drives price even higher. And when the algorithm realizes it's wrong, when it detects that its position is losing more money than the predefined risk threshold, it doesn't calmly exit. It panics. It executes a stop loss by buying back the position or buying futures to hedge. And if every market maker's algorithm is hitting its risk limit simultaneously, you get a liquidity cascade where the bids disappear, the offers vanish, and price gaps up $2 or $3 in a single tick, exactly like what happened in the 2010 flash crash when algorithms sold off the entire S&P 500 by 9% in 5 minutes, or like Knight Capital in 2012 when a software glitch caused the algorithm to buy $7 billion worth of stocks in 45 minutes and lose $440 million before anyone could shut it down. And the reason this is so dangerous right now, tonight, is that we're not just dealing with domestic market makers, we're dealing with a geopolitical dimension where China imported 1,247 metric tons of silver in January 2026 alone, which is 40 million ounces, triple their normal monthly average, because the Chinese government sees the same gamma wall, the same COMEX open interest data, the same depleting registered vault inventories, and they're draining the physical market ahead of the squeeze, and the Shanghai Futures Exchange silver price is already trading at a $1.80 premium to COMEX, which is not normal. Shanghai usually trades at a $0.20 to $0.50 premium, and a $1.80 premium means there's a shortage in China. It means the arbitrage is broken, and when COMEX price spikes tomorrow, that premium could widen to $3 to $5, and at that point you have a bifurcated global market where the West has a paper price and the East has a physical price, and the two are no longer connected. And this isn't just about investment returns, this is strategic because silver is used in 85% of the world's solar panels, which China manufactures. Silver is used in electric vehicle batteries, where China dominates the market. Silver is used in 5G infrastructure, which China is deploying faster than any other nation. And if you control the silver supply, you control the supply chain for the entire green energy transition, which is exactly what the Chinese Communist Party understands and why they're positioning themselves to corner the physical market while Western banks play paper games on the COMEX. And the historical precedent you need to understand is the Hunt brothers in 1979 and 1980, when Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market by buying physical and futures contracts controlling approximately 190 million ounces at the peak, which drove price from $6 per ounce to $49.45 in 12 months, an 824% increase, until the exchanges changed the rules, implemented Silver Rule 7, increased margin requirements, and forced the Hunts to liquidate, bankrupting them and suppressing silver for the next 20 years. Except the difference between 1980 and 2026 is that the Hunts were private individuals who could be targeted, regulated, and sued, whereas if the Chinese government is the entity accumulating silver in 2026, you cannot regulate them, you cannot sue them, you cannot force them to liquidate. They're a sovereign nation with $3 trillion in foreign reserves and a multi-decade strategic commodity policy, and there's no COMEX rule, no margin requirement, no legal mechanism that can stop a central bank from buying as much silver as they want, which means this isn't a private corner, this is a state-level operation, and it changes everything, and the United States government is not blind. To this, the Department of Defense has silver on its strategic materials list because silver is used in missile guidance systems, in radar systems, in electrical contacts for military hardware. And if silver goes to $150 per ounce, it doesn't just affect the solar panel industry, it affects defense procurement, it affects the cost of building F-35 fighter jets, it affects maintaining the nuclear arsenal, which raises the question of what the U.S. government does if this gamma squeeze triggers a national security crisis. Do they invoke the Defense Production Act and force domestic miners to sell at a fixed price? Do they ban exports like they did with oil in the 1970s? Do they impose capital controls to prevent Americans from buying physical silver and sending it overseas? Because these are the exact same questions debated during the Hunt brothers crisis, and the answers were yes. The government did intervene, they did change the rules, and they will do it again if threatened. Except in 1980, the U.S. had domestic silver production and strategic stockpiles, whereas in 2026, the U.S. produces approximately 32 million ounces per year, only 3% of global production, most of it as a byproduct of gold, copper, and lead mining. We don't have primary silver mines in meaningful quantities. We're a net importer relying on Mexico, Peru, and China for supply, and if this market dislocates, if the physical premium blows out, the U.S. does not have the ability to stabilize price by flooding the market with domestic supply. We are structurally dependent on foreign sources, and that is a national security vulnerability that becomes glaringly obvious the moment this gamma squeeze initiates. And so here's what you need to understand about tomorrow's timeline. At 6:00 p.m. Eastern tonight, Tokyo Commodity Exchange opens, and this is the first chance for a large buyer to show their hand. Watch for a move above $79.20, which indicates serious buying pressure. Then at 8:00 p.m., Eastern Shanghai Futures Exchange opens, where Chinese state-owned enterprises trade, and if China is planning to push this, Shanghai is where it happens. Watch for volume spikes. Watch if Shanghai silver goes above 580 yen per kilogram, equivalent to $79.80 USD, because that puts you in the danger zone. Then at 3 a.m. Eastern, London spot market opens, and London is the physical market where bullion banks trade allocated bars. And if London price starts trading at a $2 or $3 premium to COMEX, that confirms the physical market is dislocating. Then at 8:20 a.m. Eastern, COMEX futures open for the day session, and this is when U.S. institutional players and algorithms start calculating gamma exposure. And if silver opens above 79.50, the squeeze is on. Watch the first 30 minutes, because if price hits $80 before 9 a.m., you could see a vertical $5 move in 10 minutes. And finally at 1:30 p.m. Eastern comes options expiration, the cutoff, after which gamma pressure dissipates, and market makers no longer need to hedge, and price could stabilize or keep running if the physical shortage is severe enough. But 1:30 p.m. is the key inflection point. And the reason I'm telling you all this at midnight on a Thursday, the reason I'm laying out the entire mechanical sequence of what's about to unfold, is because you have a choice right now, tonight, before the Asian markets open, before Tokyo starts trading in 4 hours. You can position yourself accordingly. You can call your dealer and lock in an order for physical silver before premiums spike. You can close your short positions if you're trading futures. You can buy the $85 calls or $90 calls if you want to ride the gamma wave. Or you can ignore this. You can dismiss it as conspiracy theory. You can assume the market will remain orderly and rational. And tomorrow afternoon, when silver is trading at $88 and your local coin shop is on allocation and the premiums are $50 over spot and you cannot find a single silver eagle under $165, you will remember that on Thursday night, February 5th, 2026, at 11:47 p.m. Eastern, someone laid out the entire playbook. Someone explained the gamma mechanics. Someone showed you the open interest data. Someone warned you about the Chinese imports and the dealer who stopped taking orders and the 180 Shanghai premium and the March 2020 parallel and the Hunt brothers precedent and the algorithmic fragility and the geopolitical dimension. And you had the information, you had the timing, you had the opportunity to act. And the only question that will matter when you look back on this moment is whether you did.